All right, all right, all right. Good morning, good morning. It's nice to have everybody here. We are having a very important class today, and we're going to try and discover a little bit about portfolio hedging. And many of us have portfolios that are based on the UBI theory or the universal basic income theory, right? Where we're actually deriving income from our investments rather than just watching them grow year after year after year, or not grow year after year after year. And of course, last year has been really good. Mark's been going straight up, so everybody's been happy. But what goes up must come down. And we've seen a little bit of that here in some of these funds that we've been trading. Misty is one, and Jordan Black and I wrote an article. Jordan Black wrote the article, but he and I worked together on the article. So Jordan Black wrote an article that's going to be in Pit News Magazine this coming issue, in the February issue, that's focused all around hedging. And we're going to talk a little bit. The two of us work together and we trade together, and we're trading buddies. And we both traded Misty about the same. All right. And we both held on to it a little bit too long. And we didn't do a good enough job of hedging that position. And so we took some drawdowns on it. Now, I use my drawdowns to counter some of my tax returns. So I used it. I'd rather pay the tax on the income than use the losses as a tax loss harvest. But I had losses on that Misty trade and a couple others. I had a little bit of BITO as well. So we took those off because the Bitcoin flushed like a toilet, right? The last 3 months. And we didn't hedge them. We just kind of let them fall. And we were letting we have that little calculator that talks about the different markets. So let's go jump over to the calculator. It's easier to show than it is to tell. So we're going to jump over to our little calculator here, and we're going to go over to Pit News Calculator. We're going to come up here. We're going to go to break even calculator, and we're going to put in here Misty. All right, Misty. And I'm going to show you something. LMN, where is Misty? How come I can't find Misty? LM, oh, it's up higher. And Misty right there. Okay, so this is Misty. And so the way Misty works is that when the market falls, now I'm going to come in here and show you, this is sitting right dead center. So this is MSTR, which is the underlying stock, right? So if we're trading MSTY, well, it's actually trading MSTR. MSTR is a software company that has a lot of Bitcoin. So because they have so much Bitcoin on their balance sheet, their stock trades basically like Bitcoin. So it's almost like a Bitcoin investment. It's like investing in Bitcoin. Kind of a roundabout way of doing it, but nonetheless, it's a Bitcoin investment. And the stock is very volatile because it has so much Bitcoin. And so if MSTR, let's say, just for easy numbers, started off at $100 per share at the beginning of the year, and at the end of the year, they were still at $100, this is what your MSTR stock would have done, all right? Because they're trading options on, or your MSTY would have done. They're trading options on your MSTR stock. So this red line represents MSTR. And when we're sitting here dead center, you can see that we started off with $10,000 and we ended with $10,000. So $100 a share, $100 at the beginning of the year, $100 at the end of the year, nothing happened, right? You made nothing. That's what that red line represents. So the green line represents what would have happened if you would have taken your MSTR and reinvested it, what we call drip, right? Drip your money back in, your dividends back into it. This is the green line, is what you would have done last year. This is taking into consideration the last 12 months. And so you can see that it would have gone from 10,000 to 18,000. You'd have made $8,000 if you'd have dripped your money back into Misty if MSTR did nothing, just went flat. But we all know MSTR didn't go flat last year. Well, it went from low to high and all the way from high back down to low again, all in 1 year, right? It went up, created new highs, and then came back down to basically the starting point. So it ended up actually doing kind of this same thing. So at the first of the year, you'd been making money, and then at the end of the year, this dropped back down. So let's simulate that. Now, the blue line represents if you'd have just taken the money out and gone and spent it. That's what my wife does. We have her an account, and she doesn't ever reinvest the dividends. She just takes them and spends them. That's her income. All right. So if you'd done that over the 12 months period, you'd have made 16,000. So you'd made a 1678 extra $2,000, right? Extra $2,000 if you'd have gone ahead and dripped your money back into the same fund. Now, just a little caveat here, side note, you guys all know I don't like to drip. All right. It's like, but land, if you drip, you make more money than taking it out. Well, I'm not saying to take it out either. I'm saying to be strategic about putting it into maybe back into Misty or into something else that's growing. Okay. So let's run this little scenario, here, this red line, and let's say that the market went up. Okay. Let's say that the market went up 50%, which it did, right? I mean, it went up. It really went up a lot. And so it went up 50%. So it went from $10,000 and it went up to and made $15,000. All right. So your Misty went up and made $15,000 last year, or $5,000 if it went up 50%. But if your Misty went up 50%, well, that means that your drip went up to 24,684%. So you made a lot more money trading MSTY than you would have had you been trading the underlying stock MSTR. All right, you would have made $24,000 starting at the same place. And then if you would have just taken the income and not dripped it, you'd have made about where's the number? 20,000. So this made $5,000 more. Okay, and then of course this is when you went from 10,000 to 15,000 on the stock itself. So the red line again is the underlying stock. This is why we like these funds. Now, here's what happens if the market goes down, because if we don't go from last year, we just go, what happened if we just drop 50%? So go back to zero and then go all the way down to dropping 50%. What happens? Okay. Well, when you drop 50%, you lose a lot of money in the underlying stock. When the markets go down, everybody loses money. All right. Even now in the Misty fund, you didn't lose money. You just didn't make as much. All right. That's why we like these funds. That's why we didn't hedge them. All right. Because we're still making these big commissions coming in, or these big distributions. So rather than, I mean, the problem is the market went down more than 50%. I mean, it dropped fast in 3 months. And so the dividends couldn't outperform. This is over a 12-month period. And we don't have the ability to say, well, if it would have dropped 50% in 3 months, what would have happened? Well, we know what happened because this green line was actually down here. And we actually lost money. Now, we didn't lose as much money had we had the underlying stock. If we had the underlying stock, our $10,000 would have turned into $5,000, right? Lost 50% of the value. But this lost money, but because of the dividends, it still, at the end of the year, if it drops 50%, it still shows a profit. It shows a profit of, we started with 10,000 and we now have 2,663. That's in a perfect world, and that's just kind of growing like this or growing like that. This is a model, all right? So you go off the model and you understand the model. And the model can move, the real markets can move faster than the model. And so what happened last year in Misty, the underlying Misty, let's go look at it and I'll show you what happened. MSTY, I think I got it. I don't have it in this one. MSTR is the underlying stock. And so what happened is this happened really fast. See this? So if we come in here and we bring this stock in, and now this is the one that we had, and this is what we wrote the article about, and we have full transparency showing how much money we lost and everything. So we come in here, and I bought it right. Actually, I bought Misty back in here. So I had a really good run, and I added some in. So I ended up with a dollar cost average, but I started off with my dollar cost average right around here. And then what happened is it came way up, made a lot of money, really happy. And then it came all the way down. And I'm like, well, I think it'll go back up. So I bought more, which brought my dollar cost average up into here somewhere. Okay. So I bought more in here. And then it went up and we were doing really good. Happy, happy, happy. Oh, everybody's happy. And then suddenly my dollar cost average is sitting right about here. Right. And then this happened. Whew. So did I lose money on Misty? No, I didn't. I made a lot of money on Misty over the last period of time, right? So, because I've been in it for ever since clear back here. So I made a lot of money in Misty, but then I lost a bunch of money in Misty right here. Okay. I lost a whole bunch of money in Misty here. Why did I lose money? Well, because the market fell faster than the dividends could outperform the drop in the market. So the drop in the market was significant, way more significant than that red line could show. This little calculator, we thought at 50% loss, that would be a lot. It dropped so fast that this little green line ended up down here, and we actually lost money. we should have done something else, all right, instead of just expecting the dividends to cover the loss, because the market was falling so fast, the dividends couldn't keep up with the loss. Now, will they eventually keep up? Yeah, time heals all wounds, right? I mean, the market, as long as the market doesn't just keep going to zero, which is the chance of that's pretty low. So time heals all wounds. If I just held on to it, and I did, I got 2 accounts. Those of you who trade along with me and do this with me, and I have 2 accounts. I have one that is my main, what I call my UBI account. This is kind of what I live off right now, right? I take money out of that one and live off of it, or at least accent my money with it, my income. So if I need extra money, that's where I go. I go to get it, and I get it from there. And so I live off. I use that money to live off of. I'm not just growing a big account. So that's why you're like, well, Lan, why isn't it $3 million now? You've been trading this thing for years. Because I keep taking money out and go spending it. If you take money out and go spend it, or you have to pay taxes, right? The market doesn't grow if you spend it. That's the whole idea. But I have another account that is just growing. It's a protected account, tax protected. It's an IRA, right? It's a self-directed IRA, and that account I still keep I kept my Misty. I didn't sell it because I didn't have tax loss harvesting requirements, so there was no reason to sell it. So yes, time heals all wounds. If I hung on to it, which I did in my other account, if this comes back, I'll be fine and it'll make the dividends and we'll all be happy. And I should be buying a whole bunch more right now, right, to bring the cost down. And in reality, I did. I've done a lot. This is Bitcoin. So I bought a whole Bitcoin. In fact, I bought another bunch of Bitcoin. We were talking about Bitcoin yesterday in the class, and I bought some more Bitcoin just to bring this up to show you. I bought Bitcoin and I bought some more last night. So why don't you go ahead and watch me? I will update my Bitcoin because I bought another $10,000 worth last night. And so my Bitcoin currently, hold on. Come on, little computer. What is wrong? Well, it's being stupid. What happens when your cell phone locks up? What do? You just give up and go away? Huh, that's weird. I wanted to update that for you and show you what I did. Come on. Did you guys get the new update on your iPhones? Oh, there we go. Okay, it came through. All right, so let's change this. My quantity is now 1.1131895 Bitcoins. So I have 1.11 Bitcoins at an average cost of $91.995.22. And my profit right now says 6,000, but it's actually not 6,000. It's now gone down 4,920.48 because I added more to it and drove my average cost up. Even though Bitcoin, I think Bitcoin still went up a little. Oh, it went up a little bit and then come down today. So it's on the move. It's moving. All right. Is it going to go straight up? Nah, nothing goes straight up. Let's go back over and look at it. So that's where I'm kind of sitting. 107,000. I got $107,000 in Bitcoin right now. And that's actual Bitcoin. That's BTC. All right. So I took the money out of the $100,000. I probably had more than that. The $100,000 that I had in MSTY. Let's put MST. Oh, it's right there. MSTR. Because I had I think I might have had 200,000 or 100. I had 200,000 in Bitcoin, and now I only have 100,000. Because in that spreadsheet, my cash has changed. So I have to change my cash. Cash, because I put it back in the market. So where's cash? Cash on hand. I don't have that much cash on hand anymore because I put into the market. So cash on hand is, I have 161,041.90. I have cash waiting to go back into the market. $161,000 sitting in cash. All right. So that's waiting to go back into some of these funds. But because I dollar cost average, because I tax loss harvested, I took that money out and I have to sit out for 30 days. And this is my notepad on very professional. I took this out. This is what I've got my cash loss, my tax loss harvesting. Beatty, Biddo, Chippy, Coney, Soxy, Misty, that's what one we're talking about. Snoy, which is another one of the out of all. Look at this. Beatty, that was Bitcoin and Ethereum. Bitto, that was Bitcoin. Chippy, that's not Bitcoin. Coney, that's Bitcoin. Soxy, that's a software company. Misty, that's Bitcoin. Snoy, that's a software company. And then Tesla. So I'm sitting on the sidelines, and I took all that money out of all those Bitcoin ones, and now I've just bought one actual Bitcoin with the money while it sits on the sideline. Because if I buy Bitcoin, right, if I buy BTC, I can't. It's not going to provide me an income. It's just going to grow or shrink, right? It just sits there and it goes up and down in value. It's a store of value. Hopefully it goes up while I hold it, but it doesn't provide me an income unless I sell it. And if I sell it, then it loses its value going up and down. That's a traditional stock problem, right? If we buy IBM, or we oftentimes use Bill Gates, right, as an example. Bill Gates wanted to take all of his money out of Microsoft so he'd go spend it, do things with it, buy other things. Now he doesn't have any Microsoft. He owns 1% of Microsoft. That's it. Now, I don't feel sorry for Bill Gates. 1% of Microsoft is still a lot of money, but he doesn't own big 30, 40, 50, 60% of Microsoft like he used to. Why? Because he sold it. Now he doesn't have any Microsoft. So that's the big problem of trading the stock market, right? If we buy stocks, we have to sell them to realize the gains so that we can go buy something else. So we can go spend it, buy food, clothes, vacations, whatever it is you need to spend your money on. You have to sell it. Hold on a second. I'm losing my voice. All right. I have my lemon tea, and I also have my hot peach tea. Hot tea and cold tea, just to keep my voice going here. All right, let's make it happen here. So what we've got is we've got a situation where we need to have an income. Now, some of you don't need income, right? You got a job, you're working. This is just something you're doing for maybe for your retirement. You don't want to actually live off of your investments. But a lot of us, we don't want to work. Lazy. So we don't want to work, so we trade for an income. This is my work. This is what I do for a living. This is what I do to make money so that I can pay my bills. All right. I don't go to the store and become a teller. I don't go to McDonald's. I don't go to the gas station. I don't go be a doctor. I don't go be an engineer. I don't do any of that stuff. I do this. This is what I do for my living. And so I need income from it. And if I just buy a bunch of stocks and watch them grow, well, how do I get income? I have to sell my stocks. If I sell my stocks, then I don't have anything to grow and I have no income. So it's a catch-22, right? So you're thinking the same thing. You're thinking, well, I have this job at McDonald's and I make money and I put it into the stock market and the stock market grows. But if I wanted to live off of it, I would have to sell it. And if I sell it, I don't have it. And then I'd have to go back to McDonald's. So that's why we do what I'm calling the UBI, Universal Basic Income Portfolio. And it's all basically brand new stuff. I mean, we've only been able to have this done for us in the last couple of years. There's a company called YieldMax, right? And for those of you who've been with me, you know YieldMax. We've been looking at them before. So let's go over to their website and I'll show you. This is YieldMax. And so you go to it's yieldmaxetfs.com, and they'll show you a list of companies that they will trade on your behalf. And that's basically what they're doing. They're going to take your money, you're going to give it to them, and then they will trade it for you on your behalf and give you the income. And you can just live off of it. Ask my wife how that's what she does. We took a chunk of money that she earned and we put it into, for her, we put it into, which one did we put it into? PLTY. And that's Palantir. Now, PLTY is not Palantir. Palantir is the holding bucket that you give to YieldMax, and you put your money into PLTY. That's how you give them your money. All right. You have to give them your money so that they can trade it for you. So they're going to be traders. They're going to trade your money for you on your behalf. You're not trading when you give your money to YieldMax. You're not trading. You're not, I'm going to put it into PLTY and I'm going to trade YieldMax. No, that's not what you're doing. You're giving them your money and then they're going to trade it. All right. And then they're going to take that money And as the money goes up and down in value, well, they're going to take the profits and give them to you. They give them to you as what they call dividends. They're not actually dividends. Dividends are when you are a company like Microsoft and you share with your shareholders some of your profits. That's what a dividend is. But in the stock market, that's the mechanism used to distribute money to your shareholders. So in YieldMax, that's what they do. They use the dividend model to give you the distributions of the profits because they're going to trade options. And that's how they can make these eye-popping returns, is because they're not just trading, buy and sell shares. No, they're buying and selling options. And options have a much greater leverage, which is how they're able to make a bigger return if they're good traders. Sometimes the market goes down and they lose money, right? Just like I explained with Misty. Misty came tumbling down, and they were still making money on their options, but the options couldn't make money fast enough to cover the loss of the downslide of Misty. That happens. I mean, that's part of the game, all right? YieldMax isn't, they can't pull money out of their hiney, right? They've got to pull money out of the markets. And if the markets go flushing like a toilet, well, everybody loses money. It's just that when you trade with the YieldMax fund, you lose money more slowly. And that's why, is because they're using options to trade with. And so when you come over here and you go over, and you go over to your little calculator, it's not that you didn't lose money, it's that you didn't make as much money as you would have. And in this case, 50%. You only made over a year's period of time, you went from $10,000 and you only made, in this case, $2,600. So it went from $10,000 to $12,600. Okay. But the underlying Misty, if you would have held it, start at $10,000, you'd have lost $5,000. You'd end up with only $5,000. So Misty, if you'd have been in the underlying stock, you'd have lost a whole bunch of money. But because you were trading the Misty stock, MSTY, with the options, you still made money. You just didn't make as much as you would have, right? But that's all because the market goes up and down. So when the market goes up and down, everybody makes money. When the market goes down, everybody loses money. Market goes up, everybody makes money. Market goes down, everybody loses money. And it's with the YieldMax funds, it's not that you're losing money. It's that you're just not making as much as you were before. And if the market goes way down like Misty did, well, eventually that can't keep up. And so when Misty went down farther, that green line came below the 10,000, and it ended up losing a little bit. Not nearly as much as the red line. And that's the important thing to understand. People trade these markets like, oh, no, I'm losing money. Well, if you were in the underlying stock, you'd have not only been losing money, you'd been losing your hiney. All right. I'm trying not to say bad words because I have to go to YouTube confessional every time I say a bad word. I have to tell them I said a bad word. I said the S word. I said the bad word you don't like me to say. But after I get done and I go over and I go to confessional to post the video, I can't remember whether I said a bad word or not. So I just tell them every single video, I just say, yeah, I probably said something I didn't know. I was probably swore in. Every video, I just say, yeah, I swore in it. So that's why my videos, none of them go anywhere, because it's like Land swears in every one of his videos. We ain't promoting that video. We ain't let nobody see it. I'm a potty mouth. So I don't get lots of people watching my, because everyone I just say, yeah, I probably did. I probably said something bad in there. I just tell them every single video I said something bad. Anyway, that's how YouTube works. If you say a potty mouth, if you have a potty mouth, they don't promote your videos. And I just tell them I have a potty mouth in every video. All right. So now let's get around to what it is that we came here to talk about, right? What did we come here to talk about? We talked about hedging. And the reason we're going to talk about hedging is because there's several ways of doing this, right? So we're going to hedge our portfolio. And hedging means, of course, that we're going to try and protect ourselves to the downside. Now, the problem with hedging is that oftentimes it's said that people will spend more money trying to keep themselves from losing money than what they would have lost in the trade anyway. So that's a problem with hedging. Hedging, let's talk about traditional standard hedging. All right, let's come over here. And we'll go over, and I want to compare. The reason I think it's important for you to understand what traditional hedging is, and then I'm going to show you this other way of hedging, and it's something I should have done right here. I should have done this right here, and I didn't. All right. I didn't think the market would fall that hard. I thought it would do another one of these things. So I didn't hedge because I'm of the belief, I do have the belief that because of experience, I've done it myself. I've lost more money trying to hedge my position than I would have lost than I would have lost had I not tried to hedge. Because I try to hedge oftentimes and the market doesn't fall, so you don't use your hedge. It's like buying insurance on your car, right? You're going to go drive your car down the highway and you buy the best insurance because you're afraid you're going to crash. So you buy the most expensive insurance to cover 100% of your car, and then you don't crash. Well, you spend a lot of money that you didn't need to. If you would have had just to say, well, I'm willing to cover a little bit of that myself and have a deductible, right? Oh, okay, well, all right, I'm willing to have a $5,000 deductible on my Tesla. Well, my Tesla is a $50,000 car. So if I'm going to cover $5,000 on myself, that's a pretty high deductible. Most of you'd probably agree, right? So if you say, well, I'm going to have a $1,000 deductible, well, your premium is going to go up higher. But if you don't crash, and if you got full self-driving, right? It's a good driver. Full self-driving Teslas, they're really good. I'm impressed. You push that button and it goes and it drives. My wife gets mad at me when I turn it off, when I want to drive by myself. I'm like, I like to drive the car. It's a very high performance car. It's really fun to drive. No, if I'm in the car, you turn that full self-driving on. It's way better than you are. So it's a good, if she likes it more than she likes me to drive, it's pretty good. All right. So anyway, let's say that you never crash. So if you never crash, well, you're buying insurance that you're never going to use. And if you buy the very best insurance, right? It's like when you go to the Obamacare, right? You got gold, silver, and bronze. Well, if you're in really super good shape physically, right? You exercise every day, you're young, you're not an old codger like me that's got all the broken things happening. You're young and you're in good shape and you eat well and you're happy, you'll probably buy the bronze insurance because the chances of you using it's pretty low. Maybe an accident, but you're pretty safe. You're pretty careful. You don't have a lot of accidents, but nonetheless, physically you're pretty good shape. So you don't need really super good health insurance. You could probably buy the bronze. But when you get a little bit older, you start to crick and can't walk and legs start to tumble and you're like, well, something's going wrong. I think I better have the gold insurance, right? Why? Because you want to have better insurance because you're a bad driver. Okay. So there's that situation. And so in the stock market, when we talk about the way we invest and we're talking about these different insurance policies, that's what a hedge is. It's basically nothing more than an insurance policy that you're going to use to protect yourself. Well, if you're a pretty good trader, you might not need as much insurance as you think you do. All right. So buying a whole bunch of insurance, maybe not necessary. And so you end up spending more money on insurance than you would have made on the trade or lost on the trade. So let's come in and let's talk about an insurance policy. Okay, here's Apple. Apple's starting to tumble. And if we do our little Fibonacci dance in here, okay, Fibonacci, it says that the market has a tendency to come back down to the delta cone of probability. And if it does, and if I got a bunch of Apple, I'm going to expect Apple to come back down into this region here. Now it's already making drive 1. It's making a little counter trend drive 2. We're already in the ABC. It's hitting the 100% moving average right now. So there's a question right here. The market is going to come down. It's either going to go up at this point or down at this point. Now it could go sideways a little bit, but that little blue light's going to come in and intercept, just like this one, just like this one, just like this one, just like this one. I can guarantee you with a 100% accuracy that blue light is going to eventually intercept that red light, that price. That blue line is going to eventually cross that blue line. I promise you. It always does, always has, always will. Okay. There's always one up for every down. Now, sometimes they get a little muddled like this, and they get a little broken, but that's still one up for every down. It's just one dot. Okay. But it gets a little muddled, but in a nice trending market, you're going to get one up for every down. You see that the long one is the trend. The small one is the counter trend. So we got a long set of dots, short set of dots, long set of dots, short set of dots, long set of dots. Now we got a long set of dots coming the other way. So we got 2 long sets of dots in a row. That's a reversal. And now we got a short set of dots coming down. See how the short sets of dots were on the top side? Short sets of dots are now on the downside. Bars have turned red. Okay. So now we're in the downtrend. So we got long sets of dots, short sets of dots, long sets of dots. Are we going to get another short sets of dots and another long set of dots down here? If we are, we're going to want to hedge our position, right? Protect ourselves to the downside. Or we could just sell our shares, right? You could just sell your shares. But what does that require? If you sell your shares, well, that becomes a taxable event, unless it's if it's in a IRA, just sell them. But if you're not going to sell them, you can hedge them, all right? So you can hedge them. So we're going to protect ourselves to the downside. I'm worried about my 100 shares that I've got. I got 100 shares of Apple. And if the market falls down here, I'm going to lose a bunch of money. Well, how do I protect myself? By not selling my shares. I don't want to sell them because what if they go back up? And I don't want to have a taxable event. So if the market comes down, do I just ride through it? I'm just going to have to ride through this big drawdown and then turn around and wait for it to go back up. Well, that sucks. Nobody likes to ride through drawdowns, right? Then nobody likes to lose money. We don't know how long that market could stay down in that delta cone of probability. It could come down here, and because it's Apple, and Apple could stay down there forever, right? Stay down there a long time. Look how long. Would you stop moving around, you nincompoop? So look how long Apple can stay down. Apple can stay in a bad trend for a long time. And it even came down off of this one. Apple has not been a real, kind of a dead market. So it had a run, and if it comes back down, how long is it going to stay as a dead market again, right? So it's not like we're going to say, oh, Apple's just going to bounce and then go shooting right back up like it did before. It could, but what if it doesn't? What if it comes down here and hangs out for a while? Well, we want to protect ourselves. It's called a hedge. All right, so what we're going to do is we're going to come in here, and a traditional way to do a hedge is just come in here and buy a put option. We're going to buy a put, and we just dropped. Oh, I don't want to buy a put. This is an insurance policy. So now we're going to say, okay, how long do we want to insure ourselves against the market falling? Well, I want to insure myself for 36 days. And if I need to, I can buy another one for another 36 days, or I can buy one at 64 days. It's block pricing. So the longer I buy, the less per day it costs me. All right. Because if you break it down, how much is this divided by the number of days? Well, it's like buying bananas, right? If you buy a whole bunch of bananas, well, the store's going to give you a discount. If you only buy one banana, well, you're going to pay the highest price for it. But then you only have to buy one banana. It's $1, right? Or you can buy 183 bananas, pay $183, but you get them for less price. You probably get them for $180, right? $175, $150, maybe. You get the point. So the further out you go, the less you have to pay for the insurance per day, but it's still more dollars. So you can come in here and say, well, I'm going to just, let's go 64 days. All right. I'm going to say 64 days. Now you say, why did you pick 64 days? Because it's an example. It's not an actual thing that we're doing. All right. If we were doing an actual thing, we would do some mathematics to try and figure out how long we do some Fibonacci projections, right? To figure out how long we need to buy the insurance for, how long we think it's going to stay down here. But let's say we think it's going to come down here and it's going to stay in here for a while. So we're going to buy 64 days. And all you do is you just come in here and you buy a put option. That's it. You buy it, and look at how much it costs you, $977. And you're like, okay, well, that's some expensive insurance. Why would I pay $977 for insurance against the market falling when if it goes down there, it'll probably just turn around and come back up eventually? It's called hedging. That's what you do. All right. So this would be, if it came down here, you would lose $2,000, but you paid $980 for insurance to cover yourself so you don't lose $2,000. So you pay $980 so you don't lose $2,300. That's why you do it. Do you want the insurance or not? I don't care. It's not like there's a right and wrong answer. There's no right or wrong. It's just different. Land might do it. You might not. I might buy my insurance and you might not buy insurance. You might buy. I didn't buy insurance with Misty, but I'm going to show you how I should have and how I'm going to do it now, because we got another tool, not just a put option. Okay. We got another way of buying insurance. I'm going to show it to you and teach it to you. So what if the market just turns and goes straight back up from here? Well, you bought $985 of insurance and you're just going to lose your premium, your $985, because the market didn't go down. You didn't crash your car, or the market didn't crash. So you bought your insurance and you didn't get to use it. So what? You drive your car and you don't cry every time you don't crash your car and collect on your insurance premium, right? So that's hedging. All right. That's hedging. That's how you hedge. That's why you hedge. That's the theory behind hedging. That's why a lot of people don't hedge, because they're like, I'm going to pay $985 for the chance the market might come down here. And if it does, I get to collect on I get to collect my money, my 985, my dollars. I get to collect my 2,354 by the purple line. 2006.21, and the market fell 2006.21, so I didn't lose any money. My hedge worked. Well, you still have to pay the 985. So you got to subtract 985 from what you made. So it's got to be worth it, right? So you got to pay your premium. And they crash your car, then you just don't have to pay as much so if you buy an insurance policy, you really want the market to crash hard so you can collect a lot of money. All right. Because if it's just, the market went down and I collect my insurance policy and the market went down $900 and you paid $985, you didn't make any money. All right. So that's the name of the game on that. That's your hedge. That's your hedge. Okay, so now how can we hedge? Let's go back over to our example of MSTR. How could Lan have hedged this without buying a put? Well, first of all, we could have bought a put, maybe, because we could buy a put on MSTR. I'm sure that's not a problem. All right. MSTR, there's a 64-day put. Yep, we could have bought one. It would have cost $2,000. All right, that's what they cost right now at the money. So I'm assuming right here it would have been about the same, about $2,000 for 64 days worth of insurance. Well, how far did the market fall? Well, it fell $13,000. So I could have paid $2,000 to protect myself against a $13,000 loss. I didn't know it was going to fall $13,000. I thought it might fall this far. Okay, I thought it would come down to about right here. And I'd have lost $5,200, but still that would have been a good deal. I could have paid $2,000 to save myself $5,000. Of course, if I think the market's just going to turn right around and come right back up, then there's no reason to buy the insurance because I'm going to get the dividends coming in or the premiums coming in from the underlying stock anyway, right? So why hedge it? But this is where you would buy your put option. You wouldn't actually buy your put option over on MSTY. You're like, well, why don't you just go buy your put option on MSTY? Now, in some cases, you can. Where's MSTY? MSTY. In some cases, you can. In most cases, you can't because there's not enough volume and open interest. There's no options traded on MSTY. MSTY is just a holding bucket for your money, right? It's just a holding bucket. It's not really a stock that you trade. So you can jump in and out of it. You can buy in and buy out. But the point is, it's going to keep giving you the dividends. And so you generally don't want to get out. But if the market flushes so hard like we did here, well, there's still something we might want to try and do. But you don't want to give up your dividends. If you sell it, then you don't get the dividends. Okay? So you say, well, I'll buy insurance over here. Well, you can't. You can't come into MSTY and buy a put option because they've got them, but nobody's selling them. See that? Volume, open interest, nobody's trading them. Let's see a 36-day. Oh, there's some 10 people bought options there. The spread on them, look at the spread, $230. It's not worth it. All right. They're paying $230 on the spread. Why would you pay $375 for a premium and $230 on the spread? Makes no sense. So if you're going to buy put options to protect your downside risk on your portfolio of yield max funds, you do the hedging over here. This is where you do the hedging. So you come in and you buy put options to protect yourself to the downside, right? That's what you do. And then now we're going to go into the next step. The next step is that these guys have thought about that. They're like, oh, you know what? We should probably provide a way to hedge these really super crazy markets. So what they've done is they've done a short MSTR, right? A short MSTR, because MSTY makes money when the market goes up, right? Why? Why does it? Let's talk about why MSTY makes money when the market goes up and not when the market goes down. Because it's short convexity. Now, I know I don't want to have to go in and explain all that. All right. It's short convexity. So whenever you trade, and because they're trading options, all right, they're trading options on MSTR. So let's approach this very gently so we can understand what's happening. When YieldMax wants to trade your money for you on your behalf, and you put it into MSTY, they're going to take it, and the only market they're going to trade it on is MSTR, because MSTY is associated with MSTR. They're not going to take money out of MSTY and go trade Tesla with it. They're going to take and only trade MSTR. And because they're short convexity, what they do is they come in here, and this is how they trade it. They come over to the options, and they buy a call, all right? They buy a call right here, and then they sell a call at the exact same, actually, they sell a put at the exact same price right there. Just like that. That's what they do. So it's basically becomes, if you look over here at a little calculator, they're going to pay $75 to put that position on. What is that? So, in trading, we call that a free trade, all right? It's a long position, meaning that you're going to make money if the market rises, but you're going to lose money if the market goes down. This is called a synthetic long position. So this is how they trade your money for you on your behalf. If you put it into MSTY, they take it out and they do this with it. They buy a call and they buy a put, and they put them right on top of each other at the exact same price. That gives them what they call a synthetic long, which means that they don't have to pay hardly anything for it, only $75, but yet they're going to make as much money on the upside as the underlying 100 shares of stock would have made, and they're going to make just as much money on the downside as the 100 shares of stock would have lost. Or they're going to lose as much money on the downside as the 100 shares of stock would have lost. It's basically it's like owning 100 shares. It's exactly like owning 100 shares. That's what it is. It's owning 100 shares for $75. You're like, well, Lan, that is a cool strategy. Why don't I do that myself? I can own 100 shares of MicroStrategy for $75. Yes, you can. Why don't you do it yourself? You can do it yourself if you want to. Why don't you? Absolutely. Go do it yourself. You don't need to have MicroStrategies do it for you now that you know what they do. They have one more step, of course. They come in here and they say, well, I'm going to buy it right here, but this is what they're going to do. They're going to come in here and put a limit order in here and say, if it goes up that far, I'm going to sell it. Won't let me do it, but I can mimic it. Okay. So they're going to say, well, if it rises that far, I'm going to sell it. Okay. With a limit order. Right. But they're not going to use a limit order to sell it. That's exactly what it is. You understand what a limit order is. It's like you get into the market rises in price, you hit a specific price, you can take your profits off at that price. That's what a limit order does. So if you have a long position that costs you $75 for 100 shares because you have a synthetic long made out of options, and if you're going to buy the 100 shares anyway, right? You're going to spend $25,000 for it. You don't have to pay $25,000 for it. That's how they can do what they're doing with your money. And then they say, well, we're going to take the profit off right there if it goes that high. So theoretically, the idea is here, they're going to make the amount of money between where they got in, right? Where they got in, right here, and where they're going to get out, right here. So how much money is that? Well, they're going to make that much money, $6,904. But they're going to even do one more step besides that. This is why I like yield max in a bullish market, because they get to participate in the upside potential of the actual market because they're synthetically long the market. They're not just collecting premiums on options. That's what Granite Shares does. And we can talk about that another time. But these guys actually get to participate in the upside of the market. They get to make from where their long synthetic is to where they put their covered call, right? So we're going to come in here. And a covered call is nothing more than a limit order, right? Covered call is nothing more than a limit order. So we're going to come over here with an option. And we're going to say, I'm going to sell a call. That's a covered call. And they're going to put it up here, which is nothing more than a limit order. That's all they're doing. They're saying, I've got my synthetic long position. I'm going to sell it at that price. And I'm going to make the difference between where I bought it and where I sold it. And in this case, that's $5,394. Now, I do have a limit on that. It's 64 days, just like insurance, right? But when I sell a call, I don't only get to tell them that I'm going to sell and collect the $5,300 if the market goes up to that point by the purple line. I also get to collect the premium of the option that I sold, which is $655. So a sell call option above the market, which is a covered call, if you already own the position, is nothing more than a limit order that's telling them that you will sell your shares at that price. And if you sell your shares at that price, you get to collect $657 in premium as an insurance policy that somebody else bought, you sold. But you sold it not to be an insurance policy. You sold it because you're going to use it as a limit order to sell your shares, which you don't even actually own, because it's a synthetic long that you paid $75 for. Genius. Genius. Now, the market has to go up. But what if the market goes down? Well, we already know because we talked about it. What happens? Well, I still get to collect my premium. I still get to collect the $660 if the market goes down, right? But I didn't sell my shares. Why? Well, the market didn't go up to where I said I'd sell my shares. So if the market went down, well, I'm going to lose the same amount of money as if I lost in the trading of the stock. Same amount, because that's what it is, right? Synthetic long means it's also a synthetic short. A synthetic long means you lose money when the market goes down. It's not a synthetic short. Synthetic short means you make money when the market goes down. They have those too. You can do that as well. You can create a synthetic short. All right, so that is the name of the game. That's what Yield Max is doing. So they get to collect the 660. That's why when you're over here and you're like, well, the market went down, how come I didn't lose money? Well, you didn't make as much money, right? Because the money you made, this green line, still representing the money you received on the premium, the 660. You get to keep that. So that's this green line. That's why you get the green and the blue line. It's up here because you keep collecting this money over here, 660, 660, 660 every month, 660, 660 every month. You collect 660, 660, right? And then down here, you either make or lose money, which is this line here. Okay. So if the stock goes up, well, the red line went up. And if the red line goes up, well, you get to participate in the upside potential of that red line going up. Well, that's pretty cool. I love it. I love it. I want to do it myself. I don't want Yield Max to do it. Well, let me Yield Max do some for you, and then you go do some on your own. That's what I do. I don't want to do all of them myself. I let Yield Max do some of them, and then, because they're good at it. They're really good at it. And then I'll just do some on my own for fun. Sounds like a good idea. Of course, it's a good idea. All right. So that's what this little calculator is showing you. It's showing you the difference, the value of this trading strategy right here. So now, how do we hedge? MicroStrategy, or not MicroStrategy, Yield Max had this really good idea. They said, well, what if the market goes down? And we don't want to just come in and buy a put option because we already talked about why not, right? You can lose just as much money in the put option as you can make in the hedge, unless the market really tumbles. Now, in this case, it did. It really tumbled. It would have been good for me to have a put option, but I didn't put one on, all right, because I had this green line, and I kept thinking, well, if it goes down, I'll still make money. I just won't make as much. But because it went down so fast, the green line went below zero, and so I lost some money. All right. Is it going to come back? Yeah, it's going to come back, and it'll be fine, but time has, time heals all wounds, but time also has a cost. What am I going to do in the meantime? Well, I could lose 3, 4, 5, 6 months worth of premiums, income that I would need to go buy my Tesla with, right? So I still need the hedging money. So Yield Max thought of that, and they came in and they created short funds. So let's go back over to the Yield Max fund. You go over there to our ETFs. You can see their list of ETFs. Here they all are. Here's all the funds that they will trade for you on your behalf. Okay. They'll trade all of these funds. Okay. That's what they are. You can click on them and go in and see what they are. But some of them they're pretty obvious, right? AMD, Amazon, Apple, Babo. I think that's the Chinese Amazon. Berkshire Hathaway, Coney is Coinbase, most of the Carvana, you can tell, just from their symbols, you can tell which ones they're Google, Hoy, that's Robin Hood. Robin Hood, Hood is Robin Hood's symbol. So this is Hooy. JP Morgan Chase. You can see all these funds. Microsoft, that's Misty, that's on MSTR. Netflix, Nvidia. These are the funds that they will trade on your behalf. And what they're going to do, if you put your money into that fund, they're going to trade synthetic long positions with covered calls. That's what they're going to do. They're going to take your money and they're going to trade synthetic long positions with covered calls on those, and then they give you the profit. They keep 1%. All right. So that's how they do it. Now, when it comes to hedging, that's our responsibility. All right. They say, look, we're going to trade these things, but they only make money when the market goes up. If the market goes down, you lose money, but you still get your premium, so you don't lose as much money. And if the market goes down slow, well, the premiums can keep up with the decay of the underlying stock going down. And that's okay. You'll still make money. You just make money more slowly, or you won't make any money. You just won't lose any money. All right. It depends on how fast the market moves down. So that's our responsibility. They're like, well, if the market flushes, we're going to still trade long positions. We're not going to turn around and start trading short positions just because the market's going down. That's your decision. You got to decide when that happens. We're going to just keep trading it as if the market's going up, because overall, most of the time markets go up. It's like an insurance company. Most of the time cars don't crash. All right. Sometimes they crash. And when they crash, what does the insurance company have to do? Well, they have to pay out. But that doesn't mean that the insurance company is going to go out of business, because they're still getting all the premium. And the premiums on an insurance company business, it's mathematically modeled out. They believe, you're right, they've worked this out. They know that they're going to make more money on the premiums than what they're going to have to pay out in crash cars. It's a model that works for them. And that's the model we're doing here. We're doing the exact same model here. All right. The market doesn't crash as often as it goes up. It crashes sometimes, though. So we have to pay out. We lose. But overall, we're going to make money over the long haul. But if you're just sitting here playing it from month to month to month to month to month to month with these types of funds, you're going to get your hiney handed to you. See how I did that? Didn't use a swear word. So, but we do want to protect ourselves to the downside, but we still want to continue to receive dividends. So what we do is we don't liquidate our long position. Right? We don't get out of Misty and say, well, we're going to stop trading Misty because it's going down. I'm not going to trade Google right now because it's going down. I'm not going to trade Microsoft right now because it's going down. I'm not going to put my money into MSFT. We could do that. And some of these, that might be your choice. But for some of them, they've given us a choice. They got these right here. These are called short single stock options. So this is CRSH, crash. All right. Who crashes? I thought that was very clever. That is Tesla. Okay. So Tesla, if Tesla stock starts to go down, you can buy some CRSH and it'll still pay you dividends to the downside, because what they're going to do is they're going to take the exact same strategy, just like we talked about over here. And instead of being long, they're going to make it short. So instead of buying, right? Instead of buying a call and selling a put, they're going to sell a call and they're going to buy a put. They're going to do just the opposite. And instead of doing a covered call, they're going to do a covered put. All right. They're going to do the exact same thing. They're just going to do it in the opposite direction with the opposite thing. So you got two directions. Now you can choose. If you're going to come in here and you're going to trade Misty or Tesla, you can choose. You can say, well, I think the market's going to go up, so I'm going to put my money into this one, make money on the market going up, or I'm going to put money into that one, market going down. What you don't want to do is you don't want to say, well, I'm going to put half my money in this one, half my money in that one, and then just let them ride forever. It doesn't work that way. You'll eventually everything will just disappear to nothing. So don't do that. All right. We've done the back tests on that, historically back tested it. And those historical back tests are published in Pitt News Magazine in the February issue, and you'll be able to see them. All right. You don't want to do that. You don't want to just say, well, I'm going to $5,000 in CRSH and $5,000 in Tesla, and I'm just going to let it go forever, because it'll just eventually go to nothing. All right. So don't do that. What we want to do, though, is we want to be wise about it. We want to still try and use our skills, the skills that we talk about all the time. We're always talking about Fibonacci, Elliott Wave, accumulation, distribution. You guys have seen me pull up this little thing right here so many times that you've got it memorized, right? So this little model right here, we talk about this little model all the time. So what we want to do is we want to kind of drift our money in and out of these different funds depending on what's happening. We don't want to just go all in and all out. We can. I mean, if you're that good of a trader, you can do that. You can say, well, I'm only going to put all my money. It's right here. I know it's in the Wyckoff distribution mode, and I'm just going to take all my money out of TSLY, and I'm going to put it all into Crash. Or I'm going to take all my money out of Misty, and I'm going to put it all into, they've got one that, what is it now? Oh, it's Winter. I don't know why they call it Winter, but they do. They call it WNTR. That is the opposite side of MSTR. So what I think we should do, all right, what I'm going to do. Now, I'm not telling you guys what you should do. I'm telling you what I'm going to do. I'm going to try to be better at hedging a little bit with some of these funds. All right. So fiat is a short. I got to dips. Which ones are these? So I'm going to write them down, and we're going to go look at them. All right. We're going to see what I know it's Crash, CRSH. That one is Tesla, TSL. I know that one. Dips, I'm going to have to go look it up. I can't remember which one that crosses. Fiat, that's money. That's going to be Coney, I think. I think that crosses Coney. And then Winter, WNTR. Winter is MSTY, and then YQQ. That's pretty obvious, right? That's the QQQ. All right. So let's go see what Dips does. Let's click on Dips. We're going to come into Dips. And I'll take that one, though. She's trying to bring me some tea, but I already have like more tea on my table than I can. She's trying to bring me more tea. All right. So Dips. Let's see what yield max short NVIDIA. All right. Dips is NVDA. And we're going to go back to what's the other one? Dips, fiat. We know fiat. I think that's Coin, COI. Fiat is COIN. So we got Coin and Coney. And then the other one was, I didn't mean to do that. Come on. Winter and YQQ. We know YQQs. That's just the Qs. QQQ. Okay, so we have them all. All right. So now what we're going to do is we're going to come in here. And this is what I'm going to do. I'm going to try and be better at doing this. If I think a market that I'm in, let's go look at Tesla, because I'm in Tesla right now. All right, I have some money. Oh, I don't have Tesla. I'm waiting for Tesla to pull back so I can get in. I don't have Tesla right now because I had to sell my Tesla off for my tax loss harvesting. I can't get back into Tesla until January 29th, and it's the 15th. All right, so hoping Tesla flushes over the next 2 weeks so I can buy it low, right? But let's say we think Tesla is going to fall right here. Let's say it's going to go down and then up and then back down again. Let's say we think it's going to do that. We don't know, right? Nobody knows. That's why we use these other funds. So we can come in here with these other funds, and we can, instead of, let's just do two. Let's just come in here. Well, let's save this. Let's save this. Yeah, let's just create a new portfolio for Tesla. So we're going to say TSLA. We're going to have TSLY, and we're going to have CRSH. Those are the three funds that we're going to trade. Now, we're not going to actually trade Tesla. You can. TSLLA. If you want just straight up NAV, right? TSLY and CRSH. So work along with me. This is how we're going to do this. Okay, so there's Crash, there's Tesla, and there's Tesla. So what we're going to do is we're going to roll our money back and forth into Tesla or Tesla. Not all of it, 100%. You can. Again, you can do whatever you want. I'm going to do smaller amounts incrementally into Crash or into Tesla. All right. So if Tesla is climbing, all right, it's climbing. And I'm not going to be crazy about it because I don't want to have to, I'm not going to be, constantly hedging because I don't want to waste money on hedging. But if I think the market's going to have a pretty good downside, like if it's reaching up into the Wyckoff model quite high, like see, it went through this accumulation stage, right? It then rallied really hard, came up through here, and it's not quite an Elliott wave. This is like one drive, and it kind of did this stupid one drive here, and then it fell down and went another drive up. But nonetheless, it looks like we're getting up into here. There could be some downside potential. I don't know if this little thing right here is this little thing right here. That's the question I'm having. What's this little pullback in here? Where's that? Are we going to get the reversal, and are they going to start going into a distribution stage so they can accumulate at a lower price? That's why this happens. Why does this model happen? Well, it's the big banks and hedge funds. This is how they trade. All right, they go through accumulation stages when the market's low. That's what this is, accumulation. They're buying a whole bunch of shares of Tesla, and then they run the market up, right? And then the market runs up, and then they sell it out, and then it dipped, and they accumulated some more, and then they run it up again. Now they're dipping. Are they going to accumulate here, or are they going to distribute and drop one more? I don't know. Traditionally speaking, it looks like to me we're in this stage here, all right, up in here. It could make a little rally up and then flush. It could just come up, make the little, break the blue lights, and then flush down. I think it might give a little flush here. All right. So if it comes in like this model here and breaks the blue light and comes down, well, maybe we want to put on, we want to take some of our TSLY out of the market and put it into crash, because crash is still going to give us a distribution. So let's come over to portfolio matrix, and we're going to look at portfolio matrix if we can find it. Here it is. And we're going to look at, this is, I think I got crash in here. So this is, this is winter. So this is, I want to do crash because we're doing Tesla. So let's do CRSH. Oops, I got to CR, and there it is. Oh, I can't type. CRSH land. Okay, so there's crash. So crash, now, because the market's been going up, it's losing 57% annualized return, right? That makes sense. Tesla was going up, so crash is a short position. It's going to lose money. But if the market starts to go down, well, crash will start making money. So crash, the gains will start to increase. But look at the yield, 72%. So even if you would have been in crash this whole time that Tesla was going up, you'd have still made 17% annualized return, because it makes a 75% yield, which is crazy, right? It goes back to this, right? It goes back to this. That's a perfect example right there. Well, Tesla was actually going up. So it was making money. In this, it would be reversed. So Tesla was going in the opposite direction. This market was losing money because it was a short sell, meaning making money when the market goes down, but yet the market was going up. So this is representative of that in the reverse. So it still showed a profit. It still showed a profit, even though it was on the wrong side, because it has 75.12% yield. So now when we buy our insurance, we're not going to buy a put and pay the premium. We're going to roll our insurance premium into a short with crash, and we're going to continue to receive yield even though we may be wrong. So we don't feel so bad about being wrong. Oh, you were wrong. You didn't need to hedge it. Okay, well, I still made 75. I still made a bunch of yield. All right, I might have lost some on the gain, but I still made yield. At least I was protected to the downside in case the market flushed, but it didn't cost me any money. Probably didn't lose anything. Probably actually even made something, even having a position onto the short side. See how that works? See how cool? Oh my gosh, it's just the neatest thing ever. It's just the neatest thing ever. All right, so let's go over and do another one. Let's go back over to our, that's crash. So but we only make our decisions based on what Tesla's doing. We don't make our decisions based on what crash is doing. We don't make our decisions on what Tesla's doing. Those are just holding buckets. That's all they are. Just buckets to hold your money. You don't actually ever trade those. You just put your money into them or not. And you can move your money based on what Tesla's doing. This is how you're gonna trade now. All right, you're going to come in here and you're going to say, oh, Lan, looks like to me, based on everything I've learned, because I'm a smart guy now, I know all about technical analysis. This is a 100-period moving average, this is a 200-period moving. That's why I keep harping on us. We need to understand technical analysis. We need to understand models of market momentum, all right? We need to understand the delta cone of probability. I teach those things over and over and over and over in my classroom at the university, plus I teach them here in the labs. You have to understand that stuff so that you can decide whether to be in crash or whether you can be in Tesla, and how much you want to be in crash and how much you want to be in Tesla. Right now, it's sitting right here. It's pretty high. It looks like it might come down. So we might want to put maybe 25% into crash of our Tesla, just to protect us in case it goes down. We'll make more money if it goes down. Well, you don't have to put it in crash. No, you don't have to. Now, here's a question. Lan, if I have $10,000 in TSLY, do I take $2,500 out of cash and put it into crash so that I would then have additional money in Tesla? Or do I liquidate $2,500 out of Tesla and put it into crash? Yes, that's the correct answer. The correct answer is the core is TSLY. We always have TSLY as a core. We never sell it unless we're going to hedge it. So then what we're going to do is now we're going to start using these hedging tools that have been given to us and that we've never used in the past. All right. But we're going to start using them. So now if we think that Tesla's is going to die, we're going to sell off TSLY, the percentage that we want to put in, and put it up to crash. If it doesn't crash, no big deal. We put it back into TSLY. But we're just going to move pieces out. Now, let's say it looks like it's way up here to the very tippy peak. Oh my gosh, it's way up here. That would be a good time to move some money. All right. This would be the second time to move some money. All right. Now, once you get down in here, we don't want to be moving money into a short position. We want to be buying money. So now we start moving it back out of crash back into TSLY. Does that make sense? Because you get get down here to the delta cone of probability, right? Which is the Fibonacci ruler. So here's your delta cone of probability. So right now we're going to protect ourselves. We should have protected ourselves way up here. When it gets way extended, way up here, well, third drive. That's why we talk about Elliott waves. Drive 1, drive 2, drive 3. And the great thing about this is you can move your money into crash when the market's way up here and you're anticipating that it's going to pull back. And if it just only pulls back a little bit and then turns and goes back up again, it's no big deal. You made a few commissions. You still made your dividends, right? You can still make your car payment. And the adjustment is made on the NAV, on the net asset value of the underlying stock. And it's not that big a deal. So you just roll it back out of crash, back into Tesla again. So what we're going to do based on our trade, and we don't have to be perfect. You don't even have to be perfect. It doesn't matter. Because if you put it in crash and you're wrong, well, you still get your dividends. You just probably adjust it a little bit on the NAV. So then you roll it back into Tesla. Oh, it's still going up. I'll put it back into Tesla again. And you're going to get your dividends one way or the other. Those yield max boys, they were thinking. They're smart buggers over there. Now all we have to do is kind of get out our little decoder ring and figure out what it is that they're giving all these things for. And this is what we're figuring out, right? Personal experience says, Lan, you should have been in the winter when you're doing your, let's put up the new one. Let's do that one because it was the one that we were talking about. So we got MSTY. We got, let's put R first. How do we do that one? Tesla, yeah. MSTY, and we have WNTR. So let's pull up this one and do this one. Okay, MSTR, MSTY, and WNTR. All right, so here are our three stocks. Now we can look at them all three at the same time in track and trade if we want to. Watch this really cool little trick. Come in here and do this. You can see all three of them at the same time. Now you can see, no, let's go into MSTY. See that? Very few put options. Spread, $125. There's a better way. There's a better way than paying $26. Well, that's a one day. Let's go 36. $375 for an insurance policy with a $230 spread on it. You're going to spend more money buying insurance than what you'll ever make or lose in the markets doing it. So let's get rid of the option. We're not going to do that in these markets. We're not going to do that. Okay, we're going to come over here and we're going to look at MSTR. So the only one we really trade, remember, is MSTR. We look at MSTR from a technical standpoint. Let's come in here and let's get rid of all of our examples. Options, exit chart. There we go. All right. So what we're going to do is we're going to only trade this market. Now, of course, if we look at this chart right now, let's run through a scenario. What we should have done. Shoulda, woulda, coulda, right? What should I have done? What am I going to do next time something like this happens? What am I going to do? Okay, next time something like this happens, I'm going to look at this model and I'm going to say, oh, in an accumulation stage. Oh, they're in the rally stage. Okay. Oh, it's getting way up here pretty high and it's starting to fall. Oh, well, it looks just like the picture. Oh my hell, looks just like the picture. But then it flushed like a toilet. Now this is bearish. You see this little section right here. See that? This right here? That one right there? That's this one right here. Now, in this case, see that? This is why I didn't short the position. This is why I wasn't worried about it. I thought it was going to be bullish and go back up. But we got two models, right? Pull up the other model. This is bearish. This is the other model. Notice this one. What's the difference between those two? This one goes back up at the halfway zone, back down, right? Right. It goes into the delta cone of probability, turns and goes back up because we're anticipating a bullish market. This anticipates a bearish market. So it goes all the way 100% all the way back down. Okay. It goes all the way back down to the previous accumulation stage. See that? Big difference. Big difference. This is bullish, strong bullish market. This is more of a bearish return here. Okay. Bear market. Now, the bear market eventually turns and goes back up. Why? Because markets generally go back up. So the two models. So we got the two models, and you see which ones. You got to pull them both up at the same time. Which one are we looking at? Well, we thought it was going to be this one because we thought Bitcoin was bullish. So we thought it was this one. We made a mistake. And so it was this one. Okay. So now what we have to do, come over here. Let's get rid of this one. Boom. Let's get rid of this one and look at this one. Okay, I want to shrink this a little bit, just bring it up so we can see it a little bit better. We'll get that in there. Okay, there's what that looks like, right? So it was here, went up, turn around, come all the way back down to the beginning. In fact, it even went a little bit further than the beginning. It went here, it went up, all the way down, all the way down, all the way down. So what should we do now? In the future, what are we going to do? Right now, we don't want to be putting on a hedge. Why? Because it's all the way down here. It's in the accumulation stage. It's getting ready to rally once again. Does it mean it's going to rally again? No. Just traditionally speaking, markets go up, right? So we're going to anticipate that this is this accumulation stage, and we can start accumulating shares right now. So if you're not in Misty, if you're not in Mr. MSTR, now would be a good time to put some on. That's why I bought Bitcoin. I bought Bitcoin, not MSTR. Why? Because I'm stuck out of the market. I can't get in because I have my tax loss harvesting. I can't get in, but I did put some more in actually in my other account, which is in a every time I'm getting new dividends, I'm putting them back in, and some of them are going in back into MSTR. I'm actually buying again in MSTR, even though I lost money here, but that's because that's a different account, right? I can do it over there. And so I'm buying again. So now you want to be buying into MSTY, because we're going to participate. We're going to anticipate the market's going to start to rise up out of this accumulation stage. And so we're going to believe that the market's going to start to return. All right. Now, so we want to be buying into MSTY. Now you can buy MSTR if you want, but that's buying the stock. If you buy the stock, there's no dividends. So you don't get an income. You just get the growth. All right. And if you're going to buy MSTR and not get any growth, there's no point of buying MSTR. You might as well just go buy Bitcoin. That's why I just bought Bitcoin. That's why I just went and bought Bitcoin, BTC. Just buy the Bitcoin, and then it's going to grow way bigger than MSTR. MSTR has a drag on it by being a stock. All right. So, but doesn't mean you can't buy MSTR. You certainly can, but it doesn't make sense to. You just go buy the Bitcoin if you're going to buy MSTR. So, but you want an income out of it. You want dividends to come back to you, right? You want this MSTR, MSTY. Now, look at this. The gain, we're not going to worry about the gain because we know we've already lost the gain. Gain's down. That's a 77% loss on the gain. But the yield was 100% during that time frame for a 23% annualized return. So we still made money. All right, we still made money. I still made money on Misty. I lost money in the last little piece, but I didn't lose as much as I made over the whole time that I was in Misty. I made a lot of money in Misty. Most of the money I had in Misty, I took it and bought other things. I bought other stocks, other investments, because I don't drip, right? I take that money out and I put it other places. All right, so 77% down, but we're not going to, because if you're getting in fresh, new right now, you're not going to participate in that big drop. Now you're only going to be buying way down here, and the yield, 100%. That thing is wild, man. That is making some massive yield. So hopefully right now is a good time to buy it, because you're going to get the yield out of MSTY, and hopefully you're going to get some upside potential. Hopefully it doesn't crash and go down one more time. Could it? Yeah, of course it could. Nobody knows what it's going to do. It could do this. And if it does, what are we going to do? Well, we'll move some of our money out of MSTY and into WNTR and participate in the downside potential. How would we know that, Lan? Well, you're going to do your technical analysis, higher highs and higher lows, lower highs and lower lows. You're going to look at recurring price patterns. You're going to look at lower patterns. You're going to look at head and shoulders bottom formations. You're going to look at retracements, Fibonacci retracements, and projections. You're going to do all that mathematical stuff that's in my book. It's in my book. All right. You can get the book, the electronic digital version, at pitnews.com. Go to the store. You can get the digital version. Don't buy the digital version. Just pay the extra couple bucks. Go to Amazon and buy it on Amazon. Get the paper version. That way you can lay it out on your desk and you can have it sitting here and you can open it up and you can say, oh, right there, that's this pattern right here. I'm going to just wait for that pattern to do this. If it does this, it's what we call a decision point trading, and it makes a decision point, and then that's where you have a decision that you can make. And based on the mathematics of what we're looking at in the book, that decision point would be, I would buy winter. And you don't just go all into winter. You just say, well, I'm going to put a little bit of winter, maybe 20% of what I have in Mister into winter. Now I'm going to start getting dividends from winter, and I'm going to start getting dividends from Twitter, or from Mister, or from Misty, right? Get a little bit of dividends from both. But then what's going to happen is I'm going to be hedged to the downside with a little bit of downside protection, because I have 20% in winter. It's real. I'm going to put more in winter, right? I'm going to put more. And as markets go up, the whole idea, right? The whole idea of this strategy here is that you accumulate a whole bunch of MSTY right in here, and as markets start to go up, now you can start to move over into WNTR. So you buy all the MSTY here, and as it goes up, remember, banks, they sell all the way to the top. That's how they make their money. They buy low, and then they sell all the way up the uptrend, while we retail traders, we're buying all the way up the uptrend. And then when they get to the top, they're out of shares. They've sold everything. And that's where we have huge holdings, right? And so the market starts to fall, we lose everything. And then who do we sell it to? We sell it back to the banks, who then start buying all the way down the downtrend. So they get a big upside down, a big normal pyramid. And retail traders, we build upside down pyramids. That's why we lose money, and that's why they make money. So we want to be more like them. We want to do what they do. And that's the model right here. So we want to buy here. We're going to be putting lots of money into MSTY at this case, which is what looks like is happening right here. I would dare say, right? I've been wrong before, but I dare say this is an accumulation stage. We're going to go through this stage right here. Then we're going to start seeing a rally. And when it gets way up there, well, it'll probably turn and fall back down again, right? A little bit. Maybe it'll make a little retracement, maybe halfway again, like this. I don't know if it'll do another full retracement like the other model, but at least half, right? So once we start getting up here, we can start moving some of our money out of MSTY and into winter. And even if it doesn't fall, we still get the dividends. But if it falls, then we get the dividends and we get to participate in the downside move. So look at this. So let's go back over to the portfolio matrix, and let's pull up all of these and see the differences. Okay, so we're going to look at CRSH. That's the Tesla one. All right, CRSH. And so it makes a 75% yield to the downside. Now, granted, we're losing money because we're not losing money. We're still making 17% annualized return. Look, you can do it completely wrong and still make money. 17% annualized return is more than the S&P 500 made all last year. And we picked the wrong direction. We said Tesla was going to go down. Tesla actually went up. And this is a short trade. We still made 17%, even picking completely the wrong direction. Okay, because it lost 57% on the yield or on the NAV, but it made 75% on the yield for a 17% annualized return. Okay, so we're just trying to, what we're doing is we're getting the best of both worlds here. Okay, so even if we're wrong, we can still be right. Even if we're wrong, we can still make money. Okay, so that's crash. Okay, let's go look at the next one. Let's go look at NVDY. So this NVDY, this is the one you'd be for, and if you were long, so you'd lose 35% on the gain, but you'd make 71% on the yield. So NVDY over the last year made 36% annualized return. Great. What if it goes down? Well, if it goes down, we're going to go into dips. Let's see what dips did. Dips had lost 59%, made 53%, so it lost 5%. But if the market's going down and we picked it correctly and the market's going down, we're going to participate in the 53%. See, the NVIDIA went up, and this is making money if it went, it only lost 5% on a huge rally, 59%. It made a 59% rally and made 53% yield. It only lost 5% last year. Again, we go over to this. This is what this is saying. This NVIDIA in this market, because this was a short trade, but the market went up. So we lost a whole bunch of money, right? We still made money. Actually, we didn't, because it went down 5%. But if you'd have shorted NVIDIA, let's go just NVDA. If you'd have shorted NVIDIA, look at what you'd done. Holy cow. If you'd have shorted that, you'd have lost your shorts. You'd have been really in bad shape. Well, we know how much you would have lost because we had it right here, right? Not here, here. You'd have lost 59% of your money. Almost 60% of everything you made on a short position you'd have lost because NVIDIA went to the moon. Well, it still paid a yield of 53%. You only lost 5%. That's cool. Okay, let's go look at fiat and coin. So Coinbase is Coney. Oh, I always forget. Oh, that worked. Okay. Coney. So there's Coney. So it had a gain of -67 and a yield of 88. It still made 20%. Now I had some Coney and I didn't do that good on it. Well, 20%, but I didn't lose money on it. Let's go look at coin. Yeah, see, I would have been better off at these peaks up in here to move some of my coin over into fiat. I wouldn't have had to move all of it, but you know, here's a point where we could have moved some into fiat, saying, well, we're going to probably get a little bit of a drawdown. Even if it's only a little bit, I could always move it back. You move your money in and out. Not all of it. You don't just go 100% in, 100% out. You can, but we're going to move 20% out first, and then we'll move another 20%. Maybe we'll get down to 50, 60, 75%, all into the coin, into the, you know, and I probably want to do it on the way up. As we get up, we keep adding it like the big banks do, right? So we keep going a little bit more short, a little bit more short, a little bit more short, and then ride that big thing down. Maybe when the whole downside comes, we got 75% into the short side and only 25% to the long side. I'm not telling you what to do. I'm just telling you what I'm going to do. All right. This is kind of my kind of working through it in my head. I haven't done this. Last year, I said I didn't do this. This year, 2026, I'm going to do better. I'm going to work to make a better portfolio. Last year, my portfolio ended up around 64% annualized return, right? I'm going to try and beat that this year. And the way I'm going to do that is by trying to play a little bit more when the markets go down, have a little bit more on the downside markets. And we got some here that we can do that with. The other one, so we get done dips, we've done fiat. Have we done fiat? No, let's go do fiat. We did Coney. So FIAT, fiat. So this is the short side to Coney. Okay, so we had a -69, 68, but we had an 89% yield for 21% even. That's if you'd held it from the beginning to the end. Now, we're not going to do that. We're going to try and do a little bit better than just holding it. We're going to try and read the markets a little bit better. Now, I like to think of myself as being pretty good at this. I've been doing it for 40 years. I'm pretty good at picking out these highs and lows. Not perfect. Nobody's perfect, but I do pretty well at picking out these highs and lows. So I'm going to do pretty well. I think I trust myself to be able to roll some money into some of these short positions at the right time and roll it back out into the long positions at the other time. I'm not going to go all in. I'm not going to say sell all, buy all, sell all, buy all. No, I'm going to roll because it doesn't matter because I've got dividends coming in from both sides. So I'm just going to slowly roll back and forth and try and see if I can do a little better. If I can, if I discover that this isn't working for me, I'll tell you guys. I'll say, yeah, I've been trying this little rolly thing back and forth into the shorts and the longs. It's not really working for me. I'm gonna have to figure out what else to do. And we'll make adjustments. That's what trading is. That's always constantly making adjustments. But we're going to try and roll in and out of these longs and shorts based on what's going on in the markets. All right. And we're going to do it with the underlying stock. We got one more we'll look at before we're done. So let's go look at YQQQ. Okay, YQQQ. So this is YQQQ. That's the short. We lost a lot of money. Why? Well, because the market went straight up, right? So we had QQQ on the other side. So it went way up, made a lot of money. Now the short is YQQQ. What is the long for YQQ? Is it QQQY? I'm going to make a wild guess here. That's Defiance. That's not it. I didn't write it down, and I don't know. Let's go look. We go look it up. Got to go look it up. So is it just, what's their long version? See, we got YQQ, which is their short version. We got QQQ, which is the underlying stock. What's their long version of QQQ? You would think it would be like QQQY or QQY or, I don't see anything in here that's a QQQ symbol. See, they got a short QQQ right here. Where's their long QQQ? They got a bunch of new ones in here too. Look, this is Dorsey Wright ETF, FEET and FIVE. I don't know what those are. I'm gonna have to do some research. Maybe we'll do a class on it. We'll go and research it together. Yield max performance and distribution target 25s. We know that the target 25s, these are new. I didn't think they had them released yet. We have to go look at the target 25s. These are the target 12s down here. Big E, we've talked about these, SOXY, RNTY. Now they announced those a while ago. Now they've got them listed. That looks like MSST. I wonder if that's Misty. NVIDIA, and I'm not sure what test is, but those are target 25. So they're going to try and return a 25% dividend. That's what that means. This one here, they're going to return a 12% dividend. So if they make more than 12%, it'll stay in the fund, and the fund will actually grow. So if you go look at, for example, SOXY, I don't know why we're getting off on this tangent. It has nothing to do with what we're talking about, other than it's interesting. If we go look at SOXY, that's the target 12. SOXY. See? Because they only take 12% out and distribute it to you. See that? Yield is 12. So they've hit their yield. That means they have a gain of 24. That means that they're leaving the money into the fund. They could have taken it out and given it to you, but they didn't. I'm not sure if I like that. I would rather have them give it to me. Give it to me. But they left it in the fund, and so it's growing. So to take advantage of your profit, you'd have to sell it, and then you wouldn't get your 12% return. I'm not sure. I don't know about that. I'm a little on the sideline. I like it, but I don't like it. I like it, but I don't like it. I don't know why. Let's go look at MSST. These are going to be really short. They just barely started doing them. I want to go to MSST, see if it's even listed. Target 25. See, they just started it. So it's got not any history. What was the other one? and VIT. These are all going to be so new, they're not going to be any good. You can't go look at them. Soxy has some history. Biggie has some history. Biggie was pretty cool. It's the same thing. BIGY. See that? They leave some in the, so they got their target 12, and then they got 4% gain for a 16% annualized return. That's pretty cool. See, so you don't have your negative NAV, and that's, a lot of people don't like that negative NAV. So by doing this, they can target their 12% return. I don't think they should do it that way. I think they should do it the other way around. I think they should target 3 here and let this be whatever it wants to be. But that's not how they do it. I think they should just reverse it. I told them too. Do you think they listened to me? No. I'm sure what they did is they said, oh, that Land Turner told us we should do it this way. Doggone it. I wish we'd have thought of that back when we were starting this company, but now we do it this way. We can't do it Land Turner's way. Doggone it. I really wish we could have done it Land Turner's way. Why didn't we think of that? I'm sure that's the conversation they had over there at YieldMax. All right, guys. I guess we've run out of things to say. All right. That's what we're going to do. You guys stick with me, subscribe to the channel, and ring the little bell. So every time I do a live show, we'll come in here and we'll do this where we'll just work through our portfolios together, and we'll see how we do. All right. We're all in this together. Yeah. We want you don't do worse if I do better. So I want you to do good, because it doesn't make me do worse if you do well. So we want to help each other and help each other do the best we can. That's all we can do. These markets are fickle, man. They're crazy. So we better figure out the best ways we can to trade them. And the more we learn and the more experience we get, the better traders will be. We use all of our past experience of how to trade markets to apply them to these new crazy YieldMax funds and make more money for next year. All right. That's the name of the game. All right. If you guys have any questions, let me know. Here's the software I use so you can get it yourself.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's it. We will catch you guys. Today is Thursday, so the next class can be next Tuesday. So we're doing Tuesday, Wednesday, Thursday. Then we start up at the university the week after that, and then we'll do labs and the university classes for those of you who are in this local area in St. George, Utah. Or if you want to travel, you can come. All right. If you want to travel and come here and stay in an Airbnb or something and come to my classes, let me know, and I'll help you make that happen. All right. It's always fun. I always have a few guys do that. So we will see you guys Tuesday morning, bright and early, 9 a.m. See you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.